This is part 2 of problem 16-32. So we've created, using these transactions, we've journalized. Notice this is the journal. Here's our debit and credit column. We've journalized these transactions in our journal page. So now what we're going to do is we're going to prepare ORC's income statement for the year ending 2016. Use the single step format, the simplified version, which is just revenues listed together and then all expenses listed together. So let's switch back to our journal entries that we did in the previous step. And remember, I've done colorization, so we're going to look for purple, which is revenue. And remember, revenue is going to be in the credit column. So here is our sales revenue, and I believe it's the only one. Let me scroll down. I don't see any other purple. Assuming my color coding is correct. So we have sales revenue of $517,500. $517,500 sales revenue. And now we need to go through our transactions and find the expenses. So if you remember right, I've done expenses in red. So we're going to look for red. So scrolling down, we've got rent expense, $11,000. So after rent expense, scrolling down, we've got cost of goods sold, $320,000. Looking for more expenses. Yeah, so don't forget, COGS, cost of goods sold, is an expense. We've got salaries and wages expense, $88,000. And then I think I saw another red one. Income tax expense, $20,000. And we should have one more, depreciation expense. There we go, depreciation expense, $10,800. So now what we're going to do is we're going to sum these. We're going to add those up, and we get $449,800. So revenue is $517,500. Subtract our expenses of $449,800, and we get a profit of $67,700. Cool. So that was our income statement. So now we need to create our balance sheet. Once we're finished with our balance sheet, then we can create our statement of cash flows. So we're going to start with current assets. The current asset that's always listed first is cash. Now my accounting lab does not make you put these in a certain order as long as you get all the current assets in this section. So to find cash, I'm going to scroll back to the top of my journal. Cash is in green. So we just need to add and subtract these cashes. So we got 500,000 minus 54,000 minus 270,000 minus 11,000. Remember, we're looking for green. Minus 144,000 plus 465,750 minus 82,000 minus 20,000 minus 35,000, and that's it. So when we do the math, we get a total cash of $349,750. Now the next current asset that's usually listed is AR. So let's go see how much AR we have. So I believe our AR doesn't happen, scrolling down to find AR, till right here. So here's our AR going up. And then here's our AR going down. So our total AR is $517,500 minus $465,750 gives us $51,750 of AR. $51,750. Now, notice we've only got one more current asset, and that's inventory. So there's two ways to do inventory. The logical way is, remember inventory is in blue. So here's inventory going up, 270,000 plus 240,000 minus 320,000. That was our sale. So when you do the math, you get $194,000 of merchandise inventory. Now the authors must not have thought you were going to be able to do that high-level math, sarcasm intended. So they even tell you that ending merchandise totaled $194,000. So they tell you the answer right here. So we're going to add these up, and we get total current assets of $595,500. Okay, now we need to find our plant assets. And the only thing that was depreciable that this company bought are these store fixtures, $54,000. Now we also have to show how much depreciation has accumulated. So we're going to subtract less accumulated depreciation, and that was at the end of our journal. Our accumulated depreciation is right here, $10,800. I like to put the minus sign there to remind me to subtract. I believe my accounting lab does not enforce you to have that. So when we do the math, 54,000 minus 10,800, we get 43,200. So our total assets is 43,200 plus this 595,500 gives us total assets of 638,700. Okay, we're halfway done with the balance sheet. Now let's do our current liabilities. So traditionally the first current liability is AP. So let's go see what we have for AP. Scrolling down, here's AP going up, it's $244,000. And then here's AP going down, $144,000. So that gives us a balance of $100,000 of AP. And our other current liability is the salaries payable. At the end of the year, we still had $6,000 of salaries payable that we had to pay. So that is our other current liability. So giving us $106,000 of current assets, current liabilities. So now we have the stockholders' equity section, which for this company, remember they issued common stock, and they did have a profit, so they have some retained earnings. So let's work on common stock first. That was the very first transaction. Common stock, $500,000. And now we have to figure out retained earnings. So remember, according to this up here, the company was formed this year. So this is their very first year. So their opening balance of retained earnings was 0. So what is in retained earnings? What is moved into retained earnings? Well, net income, right? So retained earnings, remember, is net income or retained earnings, same thing. Income we've kept, which means it's net income that has not yet been paid out in the form of dividends. So let's go calculate or go find our net income. We got 67,700. Where did I get that from? Right here on the income statement we created. But remember, retained earnings is past profits, so this 67,700 that have not yet been paid out in the form of dividends. Now, didn't we pay a dividend? We did. So let's go see how much the dividend was that we paid. So right here, here's a transaction where we paid the dividends. We declared them and then later we paid them. So this cash dividends, remember I added this little, I don't know if you noticed this, but I added this little parentheses here, a little note that says cash dividends is later closed to retained earnings. So this 35,000 is lowering retained earnings. So we have to subtract that from our retained earnings. So 67,700 minus the $35,000 of dividends gives us a balance of 32,700. And then our total stockholders' equity is 532,700. Now here is where you hope and pray that liabilities plus owner's equity is the same as total assets. So this plus this, our total liabilities, we don't have any long-term liabilities, plus equity has to be the same as this. And in this case, it works out 638,700. Okay, so that was our balance sheet. Now we can create our statement of cash flows. So remember, the statement of cash flows starts with net income. So to find our net income, if we forgot what the number was, and I did forget it, just scroll back up here, income statement 67,700. And to remind you what goes into the operating section, so remember this is the operating section that we're working on. What goes in the operating section, this section right here, but blown up right here so you can see it better. After net income, we have depreciation. Then gains and losses are backed out. Then we have to analyze our changes to current assets and changes to current liabilities. So we've done net income. Let's do depreciation. So what was our depreciation expense? It was 10,800. We get that, of course, from our income statement. Next, we're going to back out any gains or losses. And when we did the journal entries, there were no gains or losses, so we're going to skip that. Then we have to analyze our current assets and analyze our current liabilities. So to do that, we just need to go to our balance sheet. So our first current asset is right here, AR. So which way did AR go? Well, normally we had another column that showed the previous year's balance. But remember, this is a new company. So our previous balance was 0 for all these accounts. So AR went from 0 to 51,750. According to our rules, if a current asset increases, we have to subtract from cash. So our increase in AR is going to be minus 51,750. And the other current asset is inventory. So inventory went from 0, since this was a brand new company, to 194,000. So if inventory went up, then the net effect is cash goes down. Now you might be saying, well, what if we bought that inventory on account? Well, the on account part gets analyzed when we analyze AP. So again, if inventory went up, cash in theory goes down, and that jives with our rules. Increase in current assets, then cash goes down. We subtract. So let's go down to our statement of cash flows. Increase in inventory, and so we're going to put minus 194,000. And then we have two current liabilities to analyze. And it went up from 0 to 100,000. So the rule is if a current liability increases, you add. So we're going to have to add $100,000 to or for increase in AP. And then we also had an increase of salaries payable right here of 6,000. And again, the rule is the same as the last one. Increase in current liabilities, you're going to add. Increase in salaries payable, we're going to add the $6,000. So we are now done analyzing the current assets over here and our current liabilities. So for the operating section, we're done. We're going to sum these. And we get minus 128,950. So we take the 67,700, subtract the 128,950, we get minus 61,250. So this company, in their first year, not surprisingly, has a negative cash flow from operations. Most new companies do have a negative cash flow from operations. Now, we're going to analyze changes in our plant assets, the investing section. So remember, the investing section has changes to long-term assets, as you can see over here, or if you like this grid system, changes to long-term assets go in the investing section. So, and remember, to go in the investing section has to involve cash. So let's go back and look in our journal entries. When we got that plant asset with store fixtures, did we pay cash? Here it is. We got store fixtures, and the key part is we paid cash. So we're going to put cash payment for acquisition of store fixtures, and they cost us $54,000. And since we paid cash, cash is going down, so it's a minus. And that was the only plant asset we bought. So we're done with this section. Minus 54,000. Now we're going to analyze the financing section. So remember, the financing section over here includes changes to long-term liabilities and changes to owner's equity. So we didn't have any long-term liabilities, so we can skip that. But we did have changes to owner's equity. So the changes to owner's equity are things like issuing stock and paying cash dividends. So let's look to see when we issued our stock. When we issued our stock, we did get cash. So we received cash for issuing stock. Cash receipt from issuance of common stock. And since we received cash, this is a positive number. And then the other equity account that was affected is our retained earnings by paying cash dividends. So let's see what our cash dividends were. So when we paid our cash dividends, we paid $35,000. cash payment of dividends. Since we paid cash, it's a negative. And those were the only two equity accounts that are affected in our journal. So we are now done with the financing section. So we can add those two up and we get $465,000 net cash provided by financing activities. So now we're ready for our net increase in cash. So remember, we ended with cash of $349,750, and since we're a brand new company, that means we started with zero. So cash increased by $349,750. $349,750. And our beginning balance was zero, and their ending balance was that same $349,750. There. We're done with our monster problem.